Everyone thinking about buying a home asks the same question. Where are mortgage rates going? This question is on the minds of first-time buyers, seasoned investors, and everyone in between. The uncertainty can be nerve-wracking. Even a small change in rates can mean hundreds of dollars more or less on your monthly payment. This can significantly impact your budget and financial planning. It can be the difference between getting your dream home or waiting on the sidelines. The stakes are high and the pressure is real. For years, we've watched rates climb and fall, each movement sparking hope or anxiety. The roller coaster of mortgage rates can be thrilling or terrifying depending on your perspective. Understanding what moves these rates is more important than ever. With so much at stake, knowledge is power. Today is September 18th, 2025, and the news is buzzing about the Federal Reserve. The Fed's decisions are closely watched by everyone in the housing market. The Fed just cut its key interest rate, and many assume mortgage rates will drop. This assumption is common, but not always accurate. But the connection isn't direct. Mortgage rates don't always follow the Fed's lead. There are other factors at play that can influence these rates. Sometimes, after a big Fed announcement, mortgage rates barely budge or even rise. This can be perplexing for those expecting immediate changes. This can be confusing and frustrating for buyers and homeowners. The lack of a clear cause and effect relationship adds to the complexity. So what really moves mortgage rates? It's a question that requires a deeper dive into the financial ecosystem. We'll look beyond the headlines and explore the real forces at play, factors that often go unnoticed but have a significant impact. Inflation, the bond market, and lender competition. These elements interact in complex ways to shape mortgage rates. By the end, you'll have a clearer picture of this complex world. You'll be better equipped to make informed decisions. This knowledge can help you navigate the housing market with more confidence. Understanding the nuances can give you an edge. You'll understand why rates move the way they do, and how to make smarter choices for your financial future. This insight is invaluable. Let's pull back the curtain on what really drives mortgage rates. The truth is more intricate than it seems. It's not just about the Fed. There are multiple layers to consider. It's about understanding the bigger picture. The interplay of various factors creates the environment we see today, and that's what we're here to do. Together, we'll demystify the world of mortgage rates and empower you to make the best decisions for your future. The Federal Reserve, often called the Fed, is one of the most influential institutions in the U.S. economy. Its decisions ripple out to affect everything from Wall Street to Main Street, shaping the financial landscape in ways both obvious and subtle. But how does it actually do this? And what does it mean for you, especially if you're thinking about buying a home or refinancing your mortgage? The Fed's main lever is the federal funds rate. This is the interest rate that banks charge each other for overnight loans, and it's a benchmark for the entire financial system. When the Fed adjusts this rate, it's sending a signal to the economy, encouraging banks to lend more or less depending on the situation. So when you hear news reports about the Fed raising or cutting rates, this is the specific rate they're talking about. It's a headline that can move markets and grab attention, but the story doesn't end there. The federal funds rate acts like a starting point, influencing borrowing costs throughout the economy. It affects everything from the interest you pay on your credit card to the rate you get on a car loan, and even the returns on your savings account. But here's something many people don't realize. The Fed does not directly set your mortgage rate. There's no secret meeting where officials decide what your 30-year fixed rate will be next week. In fact, there's no committee sitting around a table picking numbers for mortgage rates. The process is much more complex and market-driven. The Fed's influence is indirect. It gives the market a nudge, setting the tone, but it doesn't have the power to dictate exactly what happens next. Think of it as a chess player making the opening move, not controlling every piece on the board. Imagine the Fed as adjusting the temperature at the source of a river. By the time the water flows downstream to your neighborhood, it's been changed by the weather, the landscape, and countless other factors. The Fed starts the process, but it doesn't control every twist and turn along the way. When the Fed cuts rates, it's hoping to make borrowing cheaper, encouraging people and businesses to take out loans, spend money, and invest in new projects. This can boost the economy, create jobs, and make it easier for families to buy homes. The idea is that banks will pass on those lower costs to consumers, making it more affordable to get a mortgage or finance a big purchase. But that's the hope, not a promise. In reality, there's no guarantee that banks will lower their rates just because the Fed did. Sometimes other factors get in the way, and the savings don't always reach your wallet. Forces like inflation, the bond market, and global economic trends can have an even bigger and faster impact on your mortgage rate than anything the Fed does. These factors can push rates up or down, sometimes in ways that seem disconnected from the Fed's actions. So while the Fed gives the market a nudge, it's not issuing direct commands. It's more like adjusting the thermostat in a big house, hoping the temperature evens out, but knowing every room will feel a little different. In the end, the Fed is just one piece of a much larger puzzle. Its actions matter, but they're only part of the story when it comes to your mortgage rate. Your mortgage rate is shaped by a whole river of influences. Some you can see and some you can't. So let's dive deeper and explore what else really matters when it comes to the rate you'll pay for your home. Inflation is one of the biggest drivers of mortgage rates, quietly shaping the cost of borrowing money for millions of homeowners. While it might seem like something that only affects the price of groceries or gas, inflation actually has a powerful impact on your monthly mortgage payment and the interest rate you're offered by lenders. When inflation is high, your dollar buys less, and lenders worry about getting paid back with money that's worth less than when they first lent it out. This means that the real value of the money they receive in the future could be much lower, making lending riskier for them. To protect themselves from this risk, lenders demand higher interest rates when they expect inflation to rise. These higher rates help them make up for the loss in purchasing power over time, ensuring their investment remains worthwhile. Even the fear of future inflation can push rates up as lenders try to stay ahead of any potential loss. Sometimes it's not just the current numbers, but the anticipation of what might come that causes rates to climb. Reports showing higher consumer prices can cause mortgage rates to jump overnight. A single headline about rising inflation can ripple through the financial world, affecting rates before most people even realize what's happening. On the other hand, when inflation is low and stable, lenders are more comfortable and can offer lower rates. This creates a friendlier environment for homebuyers and those looking to refinance. That's why periods of low inflation often coincide with the lowest mortgage rates in history, making it an ideal time for many to buy a home or lock in a new rate. If you want to predict where mortgage rates are heading, watch inflation reports like the Consumer Price Index. These reports give you a window into the trends that matter most to lenders and can help you make smarter decisions about your mortgage. In fact, they're often a better indicator than the Fed's announcements, since inflation data directly influences how lenders set their rates. Inflation is the silent force that can raise your rate before you even notice, quietly working in the background and shaping the financial landscape for everyone. So, if you're planning to buy a home or refinance, keep an eye on inflation. It's the hidden factor that could make all the difference in what you pay. If the Fed isn't setting mortgage rates, who is? The answer, the bond market. The yield on the 10-year U.S. Treasury note is the key benchmark for 30-year fixed mortgage rates. When investors buy treasuries, their prices go up and yields go down. Mortgage rates usually follow. When investors sell treasuries, yields rise, and so do mortgage rates. Lenders set mortgage rates at a margin above the 10-year Treasury yield. Strong economic news can push yields and mortgage rates higher. You can watch this relationship in real time on financial news sites. The bond market's collective opinion about the future gets baked into rates you're offered. So, if you want to know where mortgage rates are heading, keep an eye on the 10-year Treasury. It's the real boss behind the scenes. Mortgage rates move with the bond market, not just the Fed. Beyond treasuries, mortgage-backed securities, or MBS, are even more directly tied to mortgage rates. Lenders bundle your mortgage with others and sell them as MBS to investors. If investors are eager to buy MBS, lenders can offer lower rates to attract more borrowers. If demand for MBS drops, lenders must raise rates to stay profitable. The daily trading of MBS on Wall Street sets the rates you see. The Fed can influence this market by buying MBS, but ultimately, it's investor demand that matters most. MBS connect Wall Street to your mortgage rate. Watch this market for clues about where rates are heading. Lender competition is another factor that directly affects your mortgage rate. When the housing market is slow, lenders compete harder for your business, often offering better rates or lower fees. In a hot market, lenders may raise rates to slow down applications and boost profits. The level of competition varies by region and lender type. That's why shopping around is crucial. Get quotes from several lenders to find the best deal. Even a small difference in rates can save you thousands over the life of your loan. Lender competition adds another layer to the rate-setting process. Don't settle for the first offer. Use competition to your advantage. The health of the U.S. economy is a powerful influence on mortgage rates. A strong economy usually means higher rates. A weak economy pushes them lower. When the economy is booming, inflation and investor optimism drive rates up. In a slowdown, investors seek safety in bonds, pushing yields and mortgage rates down. Good economic news can lead to higher rates, while bad news can bring them down. The bond market often reacts faster than the Fed. Mortgage rates can be a leading indicator of economic trouble, falling before a recession is official. Watch economic reports and bond yields for clues. The economy's ups and downs are reflected in your mortgage rate. It's all part of the cycle. So why don't mortgage rates always drop when the Fed cuts rates? The answer: markets look ahead. By the time the Fed acts, investors have often already priced in the move. If the Fed's cut is smaller than expected, rates can even rise. The statement that comes with the cut matters too. If the Fed signals no more cuts, rates might go up. Mortgage rates are based on what investors think will happen months or years from now, not just today's news. The Fed is just one piece of a bigger puzzle. The bond market's expectations drive your mortgage rate. Understanding these forces empowers you as a home buyer. Don't base your decisions solely on Fed headlines. Watch the 10-year Treasury yield and inflation reports. Be prepared, have your finances in order, and be ready to lock in a rate quickly. Shop around with multiple lenders to get the best deal. Even a small rate difference can save you thousands. Trying to time the market is tough. Focus on what you can control. Find a home that fits your budget based on today's rates. With this knowledge, you can make smarter, more confident decisions for your financial future.